What are some common myths about IUL? In this episode, I will dispel at least 4 common myths about IUL. And unfortunately, it's because there's a lot of insurance agents who simply don't know what they don't know. And they're almost too proud to learn the truth, unfortunately. So get ready, because I'm going to dispel these myths and blow you away with the truth or the reality of why IUL knocks the socks off of traditional life insurance, whole life, the banking concept. A lot of times people say it's going to crash and burn. It's going to get more expensive as you get older. It's too expensive. It's full of fees. Wrong, wrong, wrong. And you'll see as I proceed. Get ready. So I'm Doug Andrew, and what do I know? Well, I've been in this financial services industry now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their authentic wealth, and prepare for long-term goals such as retirement. And my favorite financial instrument, without question, is a properly structured, max-funded, indexed universal life. If it's structured correctly and funded properly, it is deemed a laser fund. And hence, I have a book I want to gift you at the end of this episode titled The Laser Fund. It retails for $20 on Amazon. I'll gift it to you free, so stay with me. Now, when people say, what's a laser fund? Well, it is an indexed universal life. But over 99.9% of IUL sold in this country would not be qualified to be deemed a laser fund. Even though a laser fund is an IUL, that IUL has to be properly structured and maximum funded to do what I'm going to show you here. And unfortunately, that's why I think some of these myths crop up. So it has to do with some of these old beliefs versus the new beliefs. And more people are getting educated. So here we go. I'm passionate about stopping bad information from ruining what I think is the greatest financial tool in America. It's the dream solution for many financial goals, okay? So let's talk about this first myth, that the insurance policy, the IUL policy, will implode. Sometimes we say crash and burn. It's going to lapse as you get older due to the cost of insurance going up. When I hear agents say that, I just roll my eyes and I'm like, bless their little heart. They just don't understand. They immediately reveal their ignorance when they say this. They don't know what they don't know. And you can't be aware of something you're not aware of. So let's dispel that one. And while we're doing it, let's kill 2 birds with 1 stone. The other myth is that level is the devil. Even some IUL proponents say, oh, don't ever use the level death benefit, use the increasing death benefit. The level death benefit levels the devil. And I just go, bless their little hearts. And they don't know what they don't know. If you want to use IUL and have it optimize the rate of return and have the cost of insurance get cheaper as you get older, you will always use the level death benefit at some point. If you're older, you'll use it right off the bat. If you're younger, you will use it when you stop funding it. If you keep the increasing death benefit, then the first myth becomes almost true. It's going to get more expensive as you get older, okay? So let's dispel these 2 myths by doing it the right way. If you structure IUL correctly and fund it properly, then those myths are dispelled. So here we go. I began in 1974. And IUL, or even universal life, wasn't even introduced until 1980. In 1974 to 1980, I ended up being responsible for over 3,000 clients in 13 Western states. And I was a big buy term insurance and invest the difference proponent. When IUL came out, I went, okay, this is the answer. This is like buy term, invest the difference under a tax-free umbrella. And then when interest rates started to come down in the 90s, they introduced indexed universal life. Because from 1980 to 1990, I never got credited less than 11.75% tax-free on my universal life, and as high as 15.5%. But when interest rates started to come down to 10 and 9 and 8, then indexing was introduced, and that way I was still able to earn 11 and net 10 on the average on my indexed universal life, which is basically what I was doing from 1980 to the 1990s, okay? So let me show you how this works. Back in 1980, when E.F. Hutton, who was the brainchild behind the emergence of universal life, they came out with it because they realized the Internal Revenue Code, now for over a century, by the way, the only vehicle in the Internal Revenue Code that allows you to accumulate your money tax-free under Section 72E of the code, where you don't pay tax on the growth of your money, interest, dividends, or whatever, and then how you can access money out of that investment without having to pay tax, including all the gain, tax-free is Section 7702. And then at the end of the day, when you finally pass away, anything you leave behind blossoms, increases in value, and transfers income tax-free is under Section 101A of the code. What is it? It's life insurance. But in this situation, you're not using life insurance for death benefit. Whole life is primarily designed for death, okay? Universal life was introduced for living benefits, okay? And that's why when these tax citations were passed in the 1980s, in 1982, the Tax Equity Fiscal Responsibility Act, 1984, the Deficit Reduction Act, which dictates the minimum amount of insurance required with universal life to accommodate the amount of money you want to put in. You're trying to get the least amount of insurance, and it tells you what that amount is based upon your age, your gender, and your health, okay? The older you are, the less insurance you're required to have, and the insurance can become cheaper as you get older. Did you hear that? So that's dictated under TEFRA and DEFRA. Now, in a nutshell, whole life requires that you have to have more insurance than universal life requires. And so if whole life agents are trying to compare, well, $500,000 of death benefit with whole life to $500,000 of death benefit with universal life right off the bat, that's the wrong comparison. You're not comparing death benefit, you're comparing cash value growth. I can get away with less insurance with universal life, and under TAMRA, that's the 1988 rule of how fast you can put the money in, I can fund an IUL in 3 years and 1 day or 4 years and 1 day with index universal life. With whole life, it takes 6 years and 1 day or 7 payments. It's called the 7-pay test. So what I just said was you can get away with less insurance, meaning the insurance is going to cost less with universal life to accommodate the same amount of money than whole life, and you can get in the money faster, therefore it's going to grow faster with universal life than what you're allowed to do with whole life. Right off the bat, those two, and it dwarfs whole life. A lot of whole life agents don't ever get that, okay? And so these are tax citations. These are the sections of the code. So for years in my books, I've compared this metaphorically to a bucket. And so you're designing an insurance contract, an IUL, like this bucket, a repository that will accommodate the amount of money that you want to reposition to increase liquidity, safety, rate of return, and the tax benefits. And so as you do that, you have to comply with TEFRA and DEFRA and TAMRA. You want the least death benefit you can get away with to accommodate the money you want to put in there. And then you fill it up over the 4 years and 1 day, or even 3 years and 1 day if you're younger, that TAMRA dictates. So let me show you an example of how the insurance gets cheaper as you get older. You help your clients to become self-insured. And most whole life agents get a deer in the headlight look when I talk about this, okay? Because they don't get it. If I was structuring this for a male age 60, and that male came to me and said, I have $500,000 that I want to reposition in the next 5 years to increase liquidity, safety, rate of return of the tax benefits, I can get all $500,000 in there in 4 years and 1 day. Whole life would take 6 years and 1 day. And I can get away with $1 million of death benefit, whereas if this was whole life to accommodate $500,000, I might need another $250,000, $300,000 or more of life insurance. That's way more expensive. The spigot on the bucket, the cost of the insurance is going to be bigger for whole life. It's going to be more expensive. So if you earned 11, you might only net 8, but most whole life doesn't earn 11. You're lucky if you earn 8 and you only net 5. With universal life, I can earn 11 and net 10. Are you getting it? If not, you need to claim a copy of my book at the end of this episode here. So a male age 60, I can get by with only $1 million of insurance, even though he could buy way more insurance than that. That's not the objective. Whole life is primarily death benefit, okay? It has guarantees in it that'll guarantee that the money that you put in there and the dividends will keep that death benefit going. Well, if you self-insure, you don't need guarantees because there is no cost of insurance, usually after 11 years, usually before the 20th year. You are now self-insured. Your cash value has grown to equal and exceed the death benefit. Here's how it works. If I only need $1 million of death benefit and I'm putting in $500,000, if I put in $100,000 the first day of the first year, let's say, another $100,000 the first day of the second year, let's just stop right there. If I died, which I'm not planning on doing, but if I did die, they're going to pay out $1 million. Well, at that point, I've got $200,000 in there, plus whatever it grew to. But $200,000 of that $1 million is my own money. So the net amount at risk is only the remaining $800,000 if I die in the second year. The insurance company is only charging me for that $800,000 net amount at risk. They're not charging me for $1 million of insurance anymore. They're charging me for only $800,000. Let's go 4 more payments, okay? We pay $100,000 the first day of the third, fourth year. Now, 4 years and 1 day. The first day of the 5th year, I've got my $500,000 in there, plus what it's grown to. Let's say it hasn't grown to anything. Let's just be super pessimistic. If I died when I have $500,000 paid into there, they're going to still pay out just $1 million. Well, $500,000 of it's my own money. I have self-insured half of that now with my own money. They're only charging me for the remaining $500,000. The cost of insurance in 4 years and 1 day is half of what it was 4 years earlier, because the net amount at risk is only half of what it was 4 years ago. Is this making sense? Now, let's say this $500,000 doubles in 7.5 years, which it has for most of our clients. Every 7.5 years, whatever they have in there doubles without adding any money, because they're earning a net of at least 9.6 rate of return, 9.6%. 9.6 divided into the rule of 72, your money doubles every 7.5 years. So the $500,000 would double to $1 million in 7.5 years. So in the 11th year and 6th month of this policy, my cash would equal and begin to exceed the $1 million. If I die, they pay out, well, just $1 million, but the cost of insurance is zero now. I'm self-insured. I don't need any guarantees to keep that $1 million of death benefit in force, because it is guaranteed to be enforced, because now it's all my money. Are you getting it? You're self-insuring. Now, the law under Teffer and Deffer says if you happen to die, when you have $1 million of cash in there, they will pay out $1,050,000. It's 5% more than the death benefit. The insurance company is only charging you for that $50,000 net amount, and the interest you're earning on $1 million in your bucket dwarfs the cost of $50,000 of life insurance, even though you're 11 years older. Is this making sense? Now, if that $1 million doubles in another 7.5 years to $2 million in 18 years, you got $2 million. If you die, it'll pay out $2.1 million. The insurance company is only charging you for $100,000 of the $2.1 million, because $2 million of it is your own money. You don't need the guarantees of a whole life policy, because you've got double the death benefit, because that's all your own money. See, whole life agents, they get a deer in the headlight look when I say this. They don't even, I've never seen one do this. Well, yeah, because you've never seen one done correctly, okay? So when you do that, it begins to dispel these other myths, because they go, well, how can you do that? Because the other myth is that indexed universal life is simply a permanent life insurance policy wherein the cash values are invested in an index mutual fund like a variable life insurance policy. I've never owned a variable policy. I never will. They're describing a variable insurance contract. I see Dave Ramsey thinks this. Cresmont Research did a 50-year study, 1960 to 2010, and they realized that if during that 50-year period since the Great Depression, if you eliminated every single one of the loss years, normally that's 30% of the time in a 10-year period, 3 years, the market's down, but the other 7 years, the market's up. If you eliminated the loss years, you would only need 25% of the up years, and you would outperform the market. Did you understand what I just said? Indexing is way better than that, okay? So let me simplify indexing. It's not an index mutual fund. If you have $1 million of cash value at a certain point in time in your IUL policy, and if it's earning a general account portfolio of a measly 4%, which is the lowest I've ever been credited, okay? In the 1980s, I was earning 11 and 3/4 to 15 and a half. Let's use the worst. 4%. If I feel bearish about America, I can just settle for $40,000 that year, and it's tax-free. Which, by the way, you could have done that in 2008, and it was way better than the 1% or less that you would get at a bank. And it's tax-free. Now, if you feel bullish about America, you can simply say, don't risk my million. Don't invest my million in the market in an S&P 500 index fund. No. The million has to stay safe in the insurance company earning 4. What you're giving up is the 4%. You're giving up the $40,000 that year of interest so that the insurance company can fund an options budget to buy upside options in the index or the indices you choose. Let's keep it simple. Let's say you just chose the S&P 500. They buy upside options in the S&P 500. If the S&P 500 goes up that year, then if it goes up 8%, they'll pay you 8%, 80 grand. If it goes up 12%, they'll pay you 12%. They may cap you, or they may have no cap, but then they'll subtract 5% off of it. Sometimes we use that strategies when the market goes down because many of our clients have earned 61%, like in 2020 to 2021, by using a no cap strategy with a 5% charge or threshold, okay? But let's keep this simple right now. They'll pay me 8 to 12%. And people say, how can they afford to do that? They're big boys and girls. They're the number one purchaser of options in the world. They buy them hourly. But they wouldn't do it if they couldn't afford it because 40,000 of options will give them 80 or 120,000 to pay you because of the options, okay? But if the market tanks, you guessed wrong, you didn't lose your million. Your million stayed safe in the insurance company. You just relinquished the interest on your million. Does that make sense? And so in my book, I show that $1 million of cash value at a 4% general account portfolio, if you give that up, that funds an options budget that allows the insurance company to pay you gains. But if the market loses, you don't lose. The remaining $960,000 earning 4% and the general account portfolio is going to recover back to $1 million, and so you're not out anything. You didn't make anything, but you didn't lose. That is incredible. That's indexing, which is a strategy. An index mutual fund is a commodity. How would this have actually worked in the Great Recession? November of 1999. People who had $1 million saved at the turn of the century in the market, in the S&P 500, they saw that $1 million drop 35% down to $650,000. They felt like they lost their future. They had to put off retirement 7 years because it took 4 years to make back what they lost. And then when they thought they could finally retire 7 years late, what happened in 2008? As Warren Buffett put it, he said when the tide went out in 2008, it revealed who was swimming naked, meaning people weren't protected. They lost 30 to 40% again for the second time. And it took 4 years until 2012, November, to finally have $1,046,000 for the million they started with 12 years earlier. Our clients with IUL, they were cheering when the market went down because they weren't making anything, but they weren't losing. And at the end of the same 12-year period, their million in IUL had grown to $2.5 million and even $3 million by rebalancing and diversifying. $3 million instead of barely coming back to break even. Okay? That's the truth. That's not a myth. If you look at 2007 to 2012, this is so conservative. If I had an IUL with a 10.5% cap, in that 7-year period, I would have had zero. Zero was my hero. I didn't lose like I did here. I didn't make anything. I capped out. I still would have had $691,000 instead of barely, not quite, recovering the $500,000 I started with. See, that's indexing. Now let's cover the last myth. When using the banking concept, a lot of people say, well, whole life is superior. Now, the banking concept sometimes is called infinite banking by Nelson Nash, Bank on Yourself by Pamela Yellen. I've been using the banking concept long before both of them, and it's just simply becoming your own banker, okay? So when you use Indexed Universal Life, it knocks the socks off of whole life. Whole life, you might be borrowing out of your whole life policy at 4% and only earning 6. You're making a little 2-point spread. Universal life dwarfs that. Many of my clients, for example, that are business owners, they use it for working capital. For every $1 million they have in their IUL as working capital, they will use it for their business, and they will borrow from the insurance company using their cash value as collateral. They could borrow at 2% and get credited to. That's a zero net cost, but they're not becoming their own banker. They understand how money works. So they borrow from the insurance company at 5%. That's $50,000 of interest on $1 million if they borrow $1 million from the insurance company using their cash value as collateral. They don't have to write out a check for $50,000. It's automatically deducted out of whatever growth they're getting on their $1 million. Most of them are earning an average of 10.07. 10% would be $100,000. How much more is 100,050? 100% more. Would you hire an employee for $50,000 that made you an extra 100? Would you buy a widget machine for $50,000 that made you 100? That's 100% return on equipment cost or employment cost, okay? This is the banking concept. But in actuality, I have a client and he would buy real estate, strip malls, apartment complexes, fix them up and flip them, okay? He didn't like to stay and be a landlord. And in 2017, he called and said, Doug, I need $1 million out of my IUL policy to tie up a $17 million strip mall. I need $1 million of earnest money. And he knows that thing. He says, send me over the one-page document. Well, it's where he puts his name and his policy number. And the insurance company says, do you want to withdraw $1 million out of your policy or do you want to borrow? He checks borrow. It says, do you want a zero cost loan? That means borrow at 2% and keep earning 2% on that $1 million. Or do you want an indexed or what is called an alternate or a participating loan? He checks that one. So he's going to pay a higher interest rate. Back in 2017, that was 5%. He borrowed $1 million and agreed to be charged 5%. That's $50,000. But that left his entire $1 million in the policy earning whatever the index rate was. It earned 25% that year. There's not a whole life policy around that does that, okay? He earned $250,000 tax-free on the $1 million in his policy that he didn't withdraw, but he used as collateral. $250,000 minus the 50, he netted 20% or $200,000 tax-free growth on his $1 million that he actually took out and made $3 million buying, fixing up, and flipping a strip mall. I hope this is blowing you away. There's not a whole life policy I have ever seen that comes close to that. This is the banking concept on steroids. So if you want to see more examples of this, I would implore you to study my book, The Laser Fund, which is 2 books in one. This side is 200 pages, 14 chapters, all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you learn more by stories and examples. You flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories, and you'll see banking concept illustrations in here. If you want to use your whole brain, right brain and left brain, read the whole book. But you simply click on the link below. You go to laserfund.com. You contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. I'll cover the rest of that cost and I'll pay for the book. I will fire out a hard copy to you via priority mail. And while you're in there claiming your copy, if you like to listen and learn or watch and learn, there's formats for that. You can register for a free educational webinar. But here's the important part. If you want to talk to a certified IUL professional, you can schedule an appointment with no cost or obligation to see how these strategies apply in your particular set of circumstances. And if you're an insurance agent, you can check in and find out how to become a certified professional to help your clients do it correctly.